Welcome to Money Hangout. Every week we talk about one particular issue you are curious about or one burning issue which is crossing our mind all the time, and we take your questions to help you understand and invest in mutual funds better. This is brought to you by Birla Sun Life Mutual Fund and Value Research. Today we are going to talk about something which is top of our mind. Uh, Given that the market is at its all-time high or close to its all-time high, uh, which is the right way of investing? Should we stop investing? Should we should we bravely carry on with our investments, or should we start investing right now? So the cool funds to invest in a hot market is what we are going to talk about, and this is one of the biggest problem. In fact, investors always have hurt themselves by investing lump sum or getting started in a heated market or in a hot market. I don't know how hot it is, because only with hindsight we can say that the market was hot. Market was overheated. But every market rise also starts with gradual rise which sustain itself, and then we realize that it was actually not overheated. So how do we figure it out? There isn't a way around it. We can't find out. We can only say with hindsight at a future date that April 2017 was a fairly attractive level of the market, or was a overheated market. So how to approach it? This will always be the state of the market. Either it is crumbling or it is rising. It looks overheated. So, but not investing is not the way about it. The way to approach it is, find a action plan, find something which you are comfortable with, do it in a moderated way, in a calibrated way. Start investing in a manner that you don't get disappointed soon after you invest. And the way to deal with it is, today we have three kind of funds which are extremely popular, which are well on its way to popularity. First and foremost, the markets are up 20% in the last 1 year. The corporate earnings haven't gone up. Companies are not doing as well as their stock prices are doing. So this is a good enough reason for us. This is a hint which I get even from the fund managers. So the way to approach it is that you decide on your the kind of money which you are going to invest. The money which you need immediately should not be invested in the market. The money which you are likely to need in 1 or 2 years should not be invested in the market, and rest of the money which you are unlikely to need in couple of years should definitely be invested in the market. But should you be invested in the small cap fund, or should you be invested in the micro cap fund or the mid cap fund which have done very well in the recent past? No, not at all. In fact, that is something I would like to caution you about. They are exactly the kind of fund you should keep away from. And the coolest funds with which if you have never invested in the market, I think you don't consider anything beyond these three kind of funds to invest in. First is that appreciate the equity markets will be volatile. Consider balanced fund. These are the funds which invest about 3/4 of their money in equity and remaining in fixed income fund. So fixed income security. So these are funds which turn out to be, as you can see in the graph, that the stability that you derive from a balanced fund is quite comforting. Whenever there is an interim correction, balanced funds don't crumble, and that is extremely important variable for all investors who are getting started, because when you see the big ups and downs of the market reflected in your equity fund, you are prompted to act, and that action turns out to be very injurious in the long run. Then the other kind of fund which are gaining popularity, are not very popular yet, are the equity income fund, or the regular savings equity funds, which are generally nearly a third of the money is invested in equity. Remaining third of the money is invested in arbitrage position. The underlying nature is that of fixed income, but the tax treatment is like that of an equity. So these funds, because by virtue of having 65% and more into equity, but only a third of that in long only equity, and remaining just to derive the advantages of investing in an equity fund, these funds turn out to be quite advantageous tax wise, as well as very suited investment for conservative investor. Even their expenses are reasonably low. Then comes, the third kind of fund, which is meant for very conservative investor, and they could be very useful if their expenses are even lower. These are the MIPs. These MIPs invest generally no more than 20% of their money, of their funds into equity. Remaining 80% is always in fixed income. These are very suited funds for somebody who is trying to beat inflation, is trying to protect the worth of their capital. They are definitely not going to give you the rewards like that of an equity fund or a balanced fund, but they are very likely to protect the worth of your capital, because 80% of your money will generate as much return as you will get in any other competing guaranteed return fixed income, and the remaining 20% will grow to actually supplement the worth of your capital. So these are very desirable vehicles. These are hybrid funds. So all investors who have been waiting on the sidelines to invest, and they are quite surprised by and they are scared by the markets, frenzy right now, they should get started now. I think the rewards of investing and the penalty, or so to say the opportunity loss of not investing, is very severe, and markets can remain like this for a long time. So it's very important for investors to invest, and invest in growth oriented investment with your long term money. These are the vehicles to start at this point of the market, because if you start investing with very aggressive funds which are looking very popular right now, you could be in for disappointment. So wish you very best. Get started. Don't wait any further.
Thank you, Dhiren.
Thank you.
We now move to our questions for today. First up, Ajay says he has 12 funds worth about 12 lakh in total in dividend payout options. He is currently unemployed and dependent on dividends, and asks how can he pick the funds which pay the most dividends.
I would say that Ajay's premise is, of course, his investment is coming to his help, is is a happy situation, but the dividend from equity fund is not a very bankable way, and also not the right approach to evaluate a fund. When choosing a fund, you should not look at dividend but the total return, because you just might feel in a bad market the fund might give dividend, but it might be losing its value. So you will be under the false impression that your fund is doing well because it is giving dividend. Also, in an open-end fund, in an open-end equity fund, dividends don't matter, because exactly to the tune of the dividend that you receive, the value of your investments go down. Assuming a fund's NAV is 20 rupee, and it decides to give you a 20% dividend, 20% dividend on the face value, which is 2 rupee. So the day you get the dividend, your NAV becomes 18 rupee, which means the dividend is no particular gain. You get your money back, and the money is realizable in an open-end fund at any time. So investors should look at building a robust, a relatively stable portfolio, a growing portfolio, and take out the gains at a periodicity of their liking. So choose good funds, derive your income from such a fund, but this is not a very good situation. One should not be investing in equity funds to derive income unless it is a very small part of your total corpus. For example, I think a good withdrawal rate, which will ensure that your capital doesn't go down in value, should not exceed more than 5%, which means if from a portfolio of 12 lakh rupees, your annual withdrawal should not be more than 60,000 rupees, to ensure that it is growing as well as in protecting the capital. And this is not a very difficult thing, and deriving it in the form of dividend is a very undesirable way.
Moving on, Mr. Chakrabarti says that you recommend that lump sum investments be spread out over 3 years. He asks where should he keep his money during these 3 years.
I refer to this time period only for very large sum of money, which is extremely important for you. If somebody 3-year period is the maximum which I suggest, simply because you are able to capture a reasonable part of the market cycle, and this is primarily to reduce the substantial risk of catching a market high for a very important accumulation that you have done for a lifetime. So, and the way to do it is, you decide to invest in 2 equity fund. Invest in the short-term bond fund of the same fund family, and give a standing instruction to, assuming that you have 50 lakh rupees to invest, for which has to be spread over the next 3 years. So, and you decide to invest in 2 equity fund. So the way to do it will be 25 lakh rupees in 2 short-term debt fund of the corresponding, of the same fund family, into the short-term debt fund. So from here you have eliminated the possibility, because debt funds don't go down in value substantially ever. So your money will be lying in a stable asset class, and from there 1/36th, divide 25 lakh rupees by 36, and that money should be give a standing instruction. This is the standing instruction to a debt fund to move the money into an equity fund, is called systematic transfer plan. So systematically transfer your money from the short-term debt fund to the equity fund, and this is how the money which will not be invested will also continue to earn some return for you.
Mr. Shukla wants to start investing in direct plans of mutual funds. He asks, how can he invest in direct plans, and how would he be able to get a statement of his holdings?
Most mutual fund companies enable investment in direct plan from their respective website. Besides that, you can also open an account with mutual fund utility, which is a cooperative venture of all mutual fund companies. It is promoted by Association of Mutual Funds in India, of India. So every fund company has a stake in it, and you can start investing in the direct plans of any fund that you want. To get a consolidated statement, this is something which you can get online anytime. If you open your account with mutual fund utility, you can get your account statement anytime from there. You get the status of all your investments at one place. Besides that, you can always go to your registrars, the CAMs and the CARVI, which account for a substantial part of the, they cover most of the fund companies. They can give you a consolidated account statement of all your transactions to the registered email ID that you have provided at the time of making the investment.
So I think the important part here, Dhiren, is that while making investments directly with different fund houses, an investor should take care to provide the same email ID across so that it's easier to
Yes.
consolidate them.
It is very important that you provide the same email ID, otherwise you will have to make another request to, you will have to make multiple requests, get account statement on multiple accounts. Keeping it simple, one email ID will ensure that all your account statements are coming to the same account, and that will help you consolidate your statement get a consolidated statement from the registrar as well. Besides it, there is one more source from where you can get your account statement, consolidated account statement and consolidated investments. If you have a demat account, then the CDSL and NSDL, which are the two depository participants, they also provide you because they consolidate all your investments based on your PAN number, and investing in mutual fund, PAN number is mandatory. So they even without your asking, they provide you a quarterly statement of account, including your mutual fund in the demat besides the demat holdings to you every quarter.
Our next question comes from Purushottam. He says that he invests online in direct plans before 3 p.m. on days when the markets are down so that he is able to invest at lower levels. He asks if this strategy is a sound one.
No, this is not a sound strategy. In fact, this is quite a futile exercise. If at all you want to, first I strongly discourage you to do any of these things. Work on a plan of saving, investment, and be at it. If at all you are getting excited or getting tempted to try your hand or try your luck or try your instincts, create a small corpus. Create a small corpus of 25,000, 50,000, whatever you think is correct, and don't mix it with your long-term investment plan. Choose your SIPs, choose your equity fund, do your SIP. Don't combine it with these, and make sure that you are putting your long-term money and you are not going to touch it, and you swear by it. You make sure that you are, because investing is more a matter of discipline. Make sure that your long-term plans do not get distracted by your such instinct. And with this 50,000 rupee, 25,000 rupee, whichever it be your fund allocation, try it out. Try your investment hypothesis. Try your, I would say that, if at all you are trading based on some information, some stock, Take your chances, make sure that you succeed, and try and formulate your principles. If you succeed, then at a future date, after a couple of years of practice and success and credentials, you can well think of moving your money from mutual funds to investing directly. But if you try out and you find that this is not working out, you will make sure that all your financial plan will not get derailed. You will still be on track because substantial part of your money will be at work in a methodical way with professional management, with your discipline, and with convenience. So don't mix the two. And only after you have established your credentials as an investor or as a trader, and you think that it is good enough for you to really bank on your instinct and luck and strategy, then by all means formulate your plan. Don't do it now.
Moving on, Janak says that the fund manager of his debt fund changed this month. Now he wants to know, is it safe to invest a lump sum in this fund assuming that the new fund manager will maintain consistency of dividend payout?
I would say that movement of a debt fund manager is relatively less important event as compared to an equity fund in equity fund. But nevertheless, a change adds to the uncertainty. But I would say that worry about it. If you are already invested, I give him some time. If you are going to invest new money, consider other options. Debt funds, but I think there is more to a fund, more to a debt fund than its fund manager only. There is the scale of the fund company, which matters, because then they can have a company managing large amount of money in debt fund can have more number of credit analysts, will have greater say in the kind of will also have a greater pipeline of the investment avenues that they have access to. So there are some advantages of scale. That apart, I think give him some time if you are already invested, and evaluate other options. Debt funds don't vary substantially, unlike equity funds.
Next up, Jaydev, who is 27 years old and earns 80,000 per month, pays an EMI of 24,000 rupees for his home loan. He asks if he should prepay his home loan of 26 lakh rupees first or start investing in SIPs.
No, he should not prepay his home loan. He should continue his SIP, and he should carry on with he should carry his home loan. Home loan is the only kind of loan which I support, because this is a long-term loan. There is an asset backing it. If this is a home loan, if this is for a home in which you live in, you also save on the rent. More than that, the very basic rationale why you should not prepay your home loan is because it's a long-term loan on which you pay a reasonably low rate of return interest, and you also get some tax break. Besides that, if you are going to make a corresponding investment, the money which you are going to prepay, if that is used as SIP or regular investments in an equity fund over a 10-year, 15-year period, your investment in equity is bound to produce superior return than the interest that you will incur on your home loan. I would like to give an additional tip, which is not relating to mutual fund, is that home loan rates have been coming down, and many banks are inviting borrowers who have already borrowed to switch their home loan to their bank at a lower rate. So go back to your bank, reduce, and request them to reduce your, if you have taken a variable rate loan, then ask them to reduce your rate. There will be a processing fee, a nominal processing fee. Pay that and get your EMI reduced, or at least the interest will come down. If they don't allow that, then threaten them to move your loan account to some other bank, and then they will do that. So start saving on your EMI as well from here on a little bit.
Next up, Sanjeev says that you wrote a few days ago that too much money in funds may affect markets adversely. So should he stop investing in funds altogether or stick to large cap funds only?
No, don't take that conclusion from my writing. I'm writing a factual thing, that more and more Indian investors are investing in equities. They are investing through SIPs. Today, nearly 5,000 rupee comes into equity funds from domestic investors. Taking into account the lump sum investment, it can well cross 10,000 crore a month. Then 2-3 other development that has happened in the last 2-3 years. Employee Provident Fund Organization, the EPFO, which provides the provident fund to private sector employees in the country, they have started investing in equity ETFs. Earlier they were investing only 5%. Now they have started in they have gone up to they can go up to 15%, and they are investing in the ETFs which are now dominantly Sensex and the Nifty ETF. So that money is also coming into the market. The NPS is getting larger. All government employees, state government and central government employees who have come after 1st April 2004, they are part of it. Their investment monthly contribution, a part of it, nearly 10-11%, finds its way into equities. So long-term money is coming into the market, and in large quantity, and in a manner which is unlikely to go out, because this is a huge difference. What happened in the past was, whenever Indian investors got excited about equity, it was generally in a very seasonal way. It was at a point when the market was overheated, they invested, and the market corrected, and they lost money, and they either took their money out or they never came back to market again. So this time it's quite different. Steady money is flowing into the equity market. Investors but that doesn't mean that this can continue, because this is a trend which looks like unlikely to reverse very quickly. So this is a matter of fact. Think about if we are expecting large corrections, it may not materialize.
This next one comes from Suresh, who wants to know what should be the process of manually rebalancing a portfolio.
Rebalancing of portfolio requires two things. One is to frame the rule of what your asset allocation will be, and at what periodicity you will rebalance it. And the second rule which you have to formulate, first is entirely up to you. You decide to invest 75% into equity, 25% into debt. I think first time rebalancing should be done after 1.5 year, simply because it will be tax efficient. Holding of equity after redemption or selling of equity after 1 year becomes more tax efficient, and you get an opportunity to rebalance without any severe tax implication, hopefully, when equity goes up. And the second rule which you need to formulate is, there are two kind of rules which you can formulate about rebalancing. If your asset allocation goes wacky by a certain margin, assuming that you have decided to invest 75% into equity and 25% into debt, and this 75%, if it ever becomes 85%, you will rebalance. Or every 1 year you will take a look at the allocation, and if the allocation is working very much in the range of 5%, you will not rebalance, but goes beyond 5% variance, you will change. So this will bring about a degree of, don't resist your temptation to rebalance every now and then, because it will have you will cause serious transaction cost, as well as tax implication could be there. And if you are actually accumulating your portfolio, if you are actually doing your SIP, then there is another way of doing this rebalancing. Assuming that you have started to invest 2,500 rupees in a debt fund and 7,500 rupees in an equity fund, and as a result of equity markets going up, your 7,500 rupee done over the last 12 months, and you look at the investment values today, you find that your debt fund has gone up by 10%, but your equities have gone up by 20%, as a result of which your equity values are now about 85%. So the way to rebalance while you are still investing is to stop your investment in equity for 1 or 2 months, make larger investments in fixed income. This will get rebalanced without any transaction, without any new transaction to be done, without selling any investment. So it will have no tax implication. So you can periodically do rebalancing by not investing in one of the asset class to rebalance your portfolio.
Next up, Sanket asks why arbitrage mutual funds are not performing as expected, and for a short-term investor, and should we be considering to switch to other debt or hybrid funds?
Yes, if you are investing for return, arbitrage funds will give you no more return than They are likely to, the returns of arbitrage funds is likely to be anchored around the returns that you derive from liquid funds, because there are just too many arbitrage funds. Arbitrage by its very definition is, self-cannibalizing. If there is a mispricing, more people get after it, and as a result of more people getting after it, that arbitrage vaporizes. So you should, and for the last 5 years, the return from arbitrage fund is just close to what liquid funds have been able to deliver on a year-on-year basis. So lower your expectation. The only advantage of arbitrage fund is that the treatment of return from arbitrage fund is like that of an equity fund, because arbitrage is created by equity and equity derivatives, but the underlying nature of the investment is that of fixed income. So you are basically deriving interest income by doing this arbitrage trade, by this the arbitrage trade being done by the fund manager of an arbitrage fund. So expect that much return. The return could have been little higher, but most arbitrage funds also charge nearly 3 times more than liquid funds for the benefit of delivering you packaging a fixed income return in the form of an equity return. So lower your expectation. If you want, or if you want to optimize your return from fixed income, arbitrage fund will not be able to fulfill that need.
Next up, Pankaj asks how he can decide between open and closed-ended funds and how loads should affect his choice.
One is that most investors can do without, should not be investing in closed-end fund, for the basic reason that when choosing a fund, all you have is history, and when you can choose it, when you have to invest in a closed-end fund, by its very design, the closed-end fund has no history. It is getting started, and it will close, and then it will start doing. So you don't know how it will do. So a closed-end fund at the outset is just a story. It is a hypothesis, and you have to believe in that story without much of a basis. And the future is always uncertain. When it comes to an open-end fund, you know that funds have existed for a long period of time. It has existed for 10 years. How it did in a rising market, how it did in a falling market, how long has the fund manager been, what kind of portfolio the fund has built, how big it is, what is the cost. So you know quite a bit about that fund. You know nothing about the closed-end fund. The only kind of closed-end fund for which investors don't have a choice are the FMPs. That it is designed as a bond. The structure is like that of a bond. It is investing in only bonds, and by virtue of locking into a fixed time frame, it is able to give you a reasonable idea about the predictability of return. They are able to deliver predictable return. So besides FMP, I don't see any reason why any Indian investor should ever invest in a closed-end fund. And closed-end fund is also a huge compromise. Whenever investing in equity, I think it is important for investors to spread their investment, to average their investment, to do their SIP. And in a closed-end fund, you can't do that.
We'll take one last question for today, Dhiren.
Sure.
Ashok says that he has rupees 50 lakhs accumulated in pension funds. Now he wants to start investing in mutual funds and has a 10-year horizon, but he's held back by the beginner's fear. What should he do? Now, I think through this session today, Dhiren, you've already briefed our viewers about the kind of funds that they can consider to start with, but any tips on overcoming his fear?
No, in fact, he has done all the homework and all the work very nicely. He has two great advantages. One is that he still has 10 years to go. The other is that he has accumulated 50 lakh rupees in his provident fund account. He's in his pension fund. So 10 years, and I would say that he should immediately look at the amount of money which he can save every month. Start with a balanced fund and be at it for 2 years. And I think and after that he should come and report to us of his pleasure. And I don't think he will need any further guidance from there on.
Thanks, Dhiren. Any
Thank you.
closing remarks for our viewers today?
Yes, the markets are heated, and markets may not correct. You need to formulate your plan. We are earning every day, and procrastination could be in a market like this could be quite natural, but you need to really formulate your plan, get started in a calibrated way, do it in a conservative way, get started now, don't miss out on time. This can linger for a long period of time, as I explained it in the earlier part of this interaction. So getting started is very important. Get started now with confidence.
Thank you, Dhiren.
Thank you.
And thanks everyone for watching. Do join us next week as well.